Thank you for joining us for this webinar update with WHEB Asset Management. I'm Adam Myers. I lead the distribution team at Pengana, and I'm also the local investment specialist for the Pengana WHEB Sustainable Impact Fund. Joining me today is Seb Bilo, who is the head of research at WHEB, and he is going to be sharing some of the highlights from the recently published impact report, which has been titled The Age of Adoption. But I'm first going to hand over to Claire Jervis, who's the Associate Portfolio Manager, and Claire is going to be discussing the performance of the strategy during the first half of this year. If you have any questions, please enter them in the question box that can be accessed from the icon on the bottom of your screen, and hopefully we'll get to as many of them as possible in Q&A at the end. Claire, over to you.
Hi everyone, I'm Claire. I'm Associate Fund Manager on the Pengana WHEB Sustainable Impact Fund. And I'm going to start out today just by giving you a brief update on how the fund has been performing year to date. And starting out just by looking at markets, one thing that we've seen this year is very narrow market leadership, which means that a very few number of companies have been driving the majority of stock market returns, especially in the US. And those are those big tech companies like Google, Alphabet, Apple, and Microsoft, which we actually don't own in our strategy. And I'll go into some reasons why that is in just a moment. And the clear frontrunner has been NVIDIA, which is an American technology company which makes high-performance graphics chips. And these are crucial for a number of AI or artificial intelligence applications. The demand for AI has been so strong that NVIDIA has been able to actually beat their earnings expectations by 50% this year. And the hype surrounding AI and what it might mean for the future of technology has also helped to drive its share price to extreme highs. And looking at another aspect of markets, and I don't know if your social media feeds look like mine, but if they do, you will have seen a lot of Beyonce and Taylor Swift recently as they've been making the rounds with their global tours. But it's not just TikTok and Instagram where they've been making appearances. They've also been showing up in publications like the Wall Street Journal and the Financial Times. And the reason for this is that fans have been shocked by ticket prices, which are now starting to reflect the high inflation that we're seeing all over the economy. The good news is that in some parts of the world, like the US, inflation is starting to look a lot more normal. US inflation was just 3% last month. But in other parts of the world, like in Europe, inflation remains above 5%. So we are still battling a high inflation environment in much of the world. And this is how our strategy has performed over the long term. You can see that the majority of the underperformance has occurred over the last 18 months. And most of that was in 2022. The big thing that affected our strategy last year was this rotation away from growth companies to value. Now, because we're investing in change makers, companies that are solving sustainability challenges, we tend to invest in companies that are inherently quite growthy. And those companies don't tend to do so well in a high interest rate environment. So that was a headwind to our strategy last year. But this year has seen a different challenge because, like I said earlier, much of the stock market leadership has been driven by a narrow set of companies, which we don't own in our strategy. And this gives you a flavour of what's been actually going on beneath the hood. So you can see that the total return for the MSCI World Index year to date has been about 17%. And about half of that has come from the top 10 contributors. Within that, 9 of those companies aren't even in our investment universe because they're not providing solutions to sustainability challenges. So those are the companies like Apple and Microsoft and Meta. But you might ask, what about Tesla? Because of course, the electric vehicles are an important part of the sustainable transition. Well, we've historically shied away from owning Tesla because of governance concerns and the general chaos that surrounds Elon Musk everywhere he goes, and also on valuation grounds. We find it very expensive and quite hard to justify paying the share price of Tesla, considering all the impending competition from other auto companies which are bringing out electric vehicles. And this is how our strategy looked year to date in terms of the main contributors and detractors driving performance. You can see that healthcare was our weakest theme, and that was down to two different issues, which I'll go into in more detail in just a moment. Resource efficiency and water management were stronger, driven by really strong performances from advanced drainage systems in water and ANSYS and resource efficiency. And you can see on the bottom right how those tech companies in blue have impacted our performance. They're some of the biggest detractors from relative returns, simply because we don't own them. So starting out by looking at health, which, as I said, was our weakest theme, there are two real reasons driving this. The first was stock specific, and it related to a company called Globus Medical, which is a leader in spinal technology. So they build spinal robots which help surgeons perform surgeries, and it has better outcomes for patients and for the surgeons as well. But the issue with Globus is that over this year, they have announced that they're going to acquire a weaker competitor called NuVasive. You can see on the left that NuVasive has been historically underinvesting in research and development compared to Globus. And although their market share is about the same as Globus today, they've been historically losing market share pretty much every year to Globus Medical. And so we think this is going to be a messy integration. We think there's going to be culture clashes, and it has driven some underperformance this year. So we've decided that we'd rather sell the shares and watch this play out from the sidelines rather than stay in the shares and watch what could be a bumpy ride while still owning the company. But the bigger issue is really the slowdown in the pharmaceutical and biotechnology industries. So this has affected a number of our life science and diagnostics companies. Agilent is the main one it's affected. And what's been going on here is that historically, pharma and biotech has been considered quite a strong growth driver for these life sciences companies. You can see at the top that pharma was expected to drive 16% revenue growth for Agilent this year. But what's happened is that as we come out of COVID, there's been less money in the healthcare space. And during COVID, because there's so much money kind of flowing around in healthcare, a lot of Agilent's customers bought loads of products and they built these inventories, which they're now burning through. And so they're buying less products. But also things like high interest rates and the collapse of Silicon Valley Bank has meant that there's less funding to go around in healthcare in general. And so you can see at the bottom how the revenue growth for pharma and biotech for Agilent, as with many other life sciences companies, has been in pretty continual decline throughout 2022 and 23. And so that's led to some doubt as to whether these companies can actually meet their revenue targets for this year and possibly for next year as well. We do think the opportunity for pharma and biotech is still very much, still there, it's still strong. It's just that we're seeing a short-term impact from the high interest rate environment and also as we kind of normalize after COVID. More positively, resource efficiency was our best theme, and that was driven by ANSYS, which is a leader in engineering simulation software. We've owned ANSYS since 2015, and the impact story over that time has just gotten better and better. They started out by helping companies figure out how to design products in a way that's better and uses less energy, less resources. But what's happened is that over time, they've realized there's an opportunity from going further down the value chain and helping companies figure out how to manufacture those products better as well. So they're not just helping in the design, but they're also helping with the manufacture. And this is benefiting from a type of technology called digital twins, which ANSYS uses to help its customers build simulations of built real-world environments like factories, which then their customers can use to tweak different things, change different things, and see what impact that has on the use of energy and resources. And it can even help to create a safer working environment for their employees as well. So the demand for those kind of products and services has helped ANSYS to really knock the lights out for its earnings this year, and that's helped the share price. Advanced Drainage Systems was our strongest company during the year to date, and it's in our water theme. Advanced Drainage sells plastic stormwater pipes, which essentially help to convey stormwater away from homes and offices and towards somewhere that it can be safely processed. And Advanced Drainage is benefiting from two things. The first is the ongoing increase in spending on climate adaptation and resilience, particularly in US states that have already seen devastating impacts from hurricanes, like Hurricane Ian in Florida. And that's something we expect to continue, sadly, as we continue to live in a hotter world with more extreme weather events. But also something that's quite cool about advanced drainage is that they use large quantities of recycled plastic in their pipes, which means that their stormwater pipes are much more environmentally friendly than alternatives made from concrete and cement. And so as concrete prices have gone up, advanced drainage have been able to put their prices up as well, and really been benefiting from a better margin from having a better and more environmentally friendly product. And I just finished up by looking at Outlook. So it's a bit mixed at the moment. You can see that US employment has remained fairly resilient, which is good because it implies that, you know, we may be less likely to see a full-blown economic recession. But on the other hand, US industrial production has been weak, and forecasts this year suggest that it could get even weaker in the near term as well. I think it's important to remember that, as I said earlier, inflation has started to come back to normal, especially in the US, and it has started to come down in other parts of the world as well. And so it does seem to be that we are getting back to a more normal and steady state environment. Also, although these forecasts for industrial production look bleak, it's important to remember as well that a lot of this will already have been priced into company valuations. And so we don't necessarily expect share prices to follow this same trajectory. And in fact, when you think about the fact that our resource efficiency theme has been strongest year to date, and that's very industrials heavy, that does lend some comfort that that might be the case. Although it is still a very uncertain environment, and so we do still have to be mindful of all the moving parts. And just to finish up, I wanted to give you a flavour of the kind of ways the companies in our portfolio are applying artificial intelligence to solve sustainability challenges. In the healthcare space, companies like Danaher and Icon are using AI to speed up drug discovery and development, to identify new targets for promising new drugs, and even to improve clinical trials to make sure that the best possible chance of clinical trials getting to the next stage. In industry, Trimble and Xylem are using predictive software to help to optimize how we use water and resources and energy, which ultimately helps to contribute towards decarbonisation. And HelloFresh is using AI to predict customer order patterns. This means that they can be more intelligent with what ingredients they purchase from their suppliers and ultimately help to prevent food waste as well. So that's just a brief update on how our strategies performed year to date. And I'll hand over to Seb now to give an update on the impact report.
Good afternoon, everybody. Hopefully you can see my screen now. So I'm going to talk today about our latest impact report. We've obviously been having a tough market for our kind of strategy this year, and frankly, it seems like we have almost relentless bad news about environmental issues almost on a daily basis. But actually, we're quite positive about the speed at which key low and zero carbon technologies are now being deployed in the market. And that's why we've chosen as a title for our report, The Age of Adoption. We think we are now very much into a period where we are seeing an acceleration of the deployment of key technologies, whether they're solar panels or electric vehicles or heat pumps. These are no longer niche products anymore. And we certainly need to see the deployment accelerate, but we are into that S-curve, that inflection point where we've seen an acceleration already. We need that to continue to happen. But we are relatively optimistic now about the trajectory that we're on in terms of these new technologies. The other core message that I wanted to just start with today is to focus on what we call our impact model, which we have shared before, but it has become really the sort of the modus operandi for WHEB on how we structure and resource our impact activities. And the key thing to emphasize about this model really is that there are these two core aspects to how we think about impacts and how we deliver positive impacts in the real world. And the first is really this section at the top here what we call our enterprise impact. And this follows that chain through the middle of the diagram from our clients who have a desire to invest in a particular way that is consistent with their values. We use their money and have developed a series of tools that allow us to very intentionally invest in companies that have a positive impact through the products and services that they sell. We deploy our clients' capital into those companies, assemble our portfolio, and the key point is that it's the companies themselves that are delivering a positive impact through their products. And that's why we call it the enterprise impact. It's really driven by the companies that we're investing in. There is then separately what we call our investor contribution, which I'll come to in a second. But just if we stick with the enterprise impact for the moment, there are a number of ways in which we ensure that we are intentionally investing in positive impact. And at the core of this is a tool that we've developed called our Impact Engine. Again, we've talked about it before, but it's really a key tool that we use to ensure that we are, to allow us to assess the impact intensity of the companies that we're investing in. And there's a lot of information in the report this year, more than we've disclosed previously. We have this, the slide here is based on a diagram that's in the report that helps to, I think, interpret the questions that we apply across these three different categories. So when we apply the Impact Engine, we're looking at the importance of the outcomes. So how important are the changes that the beneficiaries are experiencing? How big a change do they see? And then what is the particular contribution for the company? And we've also in the report provided a worked example for a company that we own in our clean energy theme called SolarEdge. So there's a lot of interest in our Impact Engine. It's still quite innovative, and there's more detail in the report in terms of how that's applied in practice. The other or another tool that we have in the report is our impact map. Because we can we can assess each company across the spectrum of impact that they have through their products and services, and that's shown on the x-axis here. We also have our quality score on the y-axis, which includes an assessment of ESG. We can then plot our portfolio over time and see how it changes over time. So this chart here shows you each dot is a portfolio holding. The colors relate to the different themes. And if I just emphasize the triangles, which are the stocks that we sold in 2022, and squares, which are the stocks that we bought, and they include companies like Intertek, which we sold as a consequence. It has a relatively low impact score. You can see there the triangle here on the bottom left. We also sold a company called LHC Group, which operates home health services in the US. They were acquired, actually. They're a relatively high impact company, but they were acquired, so we were sort of obliged to sell that one. And then one that we bought in the year, Genmab, which is a Danish healthcare business. This is them, the square here on the right hand side, and we can calculate the change in the average of those scores from the start of the year to the end of the year, and the arrows show that. So at the start of the year we were down here, and by the end of the year we had improved the quality score of those businesses. One of the things that happened in 2022 was we saw a sharp correction in markets at the start of the year, and we took advantage of that to buy some higher quality companies, and you can see that in the change in the score here. There is a very minor reduction in impact. I mean, essentially it's the same. That was really due to the fact that we had a couple of high performing companies, high impact companies that we sold in the year. But overall, we think that's a step forward. Over time, we would hope to be graduating up towards the right-hand quadrant. So we provide a bit more information in the report about the changes that we've made over time using this impact map. And then the third tool that we report on, of course, is our impact calculator, and there's a version of this on the Pengana website as well. This is data that we've updated every year for, I think, 6 years now, and shows the underlying impact associated with an investment of $1 million Aussie dollars. So you can see what impact is associated with that level of investment in our strategy, and the impact calculator on the Pengana website allows you to plug in the actual amount, the actual amount that you or your client will have invested, and it'll calculate the associated impact. There are just a couple of things that I wanted to mention this year that we've tweaked with the impact calculator. The first thing is that there's a new indicator on the bottom right-hand side there called research and development. And essentially that's the amount of money that's spent on our research and development equipment that's supplied by WHEB portfolio companies. And this is, although all the other indicators are indicators of the ultimate outcome, the actual positive impact, R&D, of course, is an enabler of that. So it's a slightly different indicator, but we think it's quite there's quite a lot of our portfolio companies that are supplying R&D equipment, and most of that is being used to develop new healthcare therapies, although there's some also that goes into environmental research as well. So we think that's a useful addition. Another change this year is we used an independent third party for the actual underlying data. In previous years, we've collected that data ourselves and had it reviewed by the Carbon Trust. We think actually, in the long run, it's better to get this data from third parties. There are now more and more of these businesses that are supplying this kind of data, and we're using one called Net Purpose. We think in the end that will help improve the quality of the data and will certainly also make it more comparable if you want to compare our performance against others in the market, then it'll be better to do that through third parties. I should stress that we still do the impact engine analysis ourselves. So we're doing all those questions around impact intensity that I showed earlier on, but the underlying data here we're now sourcing through Net Purpose. And then the final thing that I wanted to mention here as well is we're very conscious that this is the impact calculator is very much focused on the positive impact of the products and services that WHEB portfolio companies sell. That's the point of the strategy, really, is to give you, our clients, exposure to those businesses. But there are negative impacts as well with many of these products. We report currently on the Scope 3 greenhouse gas emissions, which covers the negative impact associated with the energy use of those products. But there are other negative impacts as well. And we want to provide a more complete picture of those negative impacts. And that was one of the things that our advisory committee recommended that we do in the letter that we published in the report. So that's something that we hope to improve in future years. So that's on that enterprise impact part of our impact model. But as impact investors, we're sure that there's more that we can do, and we call that the investor contribution. And this is work that we can do directly ourselves to improve the performance of the portfolio from an environmental and social point of view. So this covers the engagement work that we do with our investee businesses, but we also want to engage with other parts of the system, if you like, the financial system, to encourage higher standards around sustainability. So we do also work quite a lot with regulators and policymakers and standard setters as well, and I'll touch on that too in a second. One area, though, that remains a big focus for us in terms of our engagement has been the work that we do on greenhouse gas emissions from companies. So to be clear, the positive impact of the products in terms of reducing greenhouse gas emissions is captured by our impact calculator that I showed a second ago. The emissions that portfolio companies generate in their operations is captured here in their Scope 1 and Scope 2 emissions. And just to explain these two charts that I've put up on the slide, the one on the left refers to some targets that we've set over the years to get our portfolio companies to set their own net zero carbon targets. So we actually achieved our first target a few years early. So we've initiated a new target, and that's shown here in this green line, which is that in the dotted blue line, by 2025, we want to see 85% of our portfolio's emissions covered by net zero carbon targets, and that by 2028, all of the companies in the portfolio will need to have a net zero carbon target. So that's the target. You can see that our performance has been pretty good so far. In green, we've reached 80% at the end of 2022. So 80% of the portfolio has a net zero carbon target. So that's the commitments. If you look at the chart on the right hand side, that's showing you the actual reductions. And of course, we would hope that these very ambitious targets that companies are setting will increasingly feed through in terms of the actual emissions. So far, just to explain this chart, this dark dotted line are our targets. So by 2030, we want to see a 50% reduction in the absolute emissions associated with our portfolio. By 2050, that needs to be net zero carbon. The grey line shows you our financed emissions. So this is the carbon footprint of the portfolio. We've sold a Chinese waste to energy business called China Everbright Environment Group a couple of years ago, and that was responsible for a very large part of our carbon footprint. So you can see this dramatic reduction that we delivered at the end of 2021. So that's the carbon footprint of the portfolio, but that includes the sale of businesses as well as ongoing emissions. And we wanted to be super clear about what the performance is of the companies in the portfolio on an ongoing basis. So removing the buys and sells, and that's this little greeny blue line at the top here. And you can see that we were doing a reasonably good job. We were reducing emissions by about 5% per year for a couple of years. It has to be 7% to meet the Paris Agreement, but not too far off. And then this year we saw a bit of a jump up, and that was driven by a COVID bounce back after COVID as companies increased their sales again, but particularly from companies like SolarEdge, who are growing extremely quickly. And of course, we want them to grow quickly because they are providing the solutions to help the economy decarbonize. But we do need to see them do a better job at reducing their own emissions. And so that's the nature of a lot of our engagement now, is with those kinds of companies. So just to give a little bit more color about the engagement we're doing, you can see here that actually for the strategy as a whole, the vast majority, nearly 75% of our emissions actually come from just 5 companies, these 5 listed here. And we've been doing a lot of engagement with these companies to get them to commit to net zero carbon targets and to reduce those emissions. So Linda is a good example where through our engagement, and others, of course, it's not just WHEB, but collectively we've managed to get the company to commit to a net zero carbon target by 2050. And that has also now been validated by the Science Based Targets Initiative. So we're really pleased with the progress there. A lot of work to do in terms of reducing emissions, but they've got a credible strategy and some good targets in place now. Another business that I wanted to mention is JB Hunt. They're a bit of an anomaly for us, certainly in this group, because they don't have a net zero carbon target. They have recently, well, a couple of years ago, their chief operating officer became their chief sustainability officer, and they are doing an awful lot of work around how to reduce their emissions. But their challenge is that they're very dependent on their suppliers. JB Hunt provide logistics services in the US, and they purchase a lot of trucks. And to date, those trucks have been powered by fossil fuel, and only in the past sort of 6 to 9 months have the truck manufacturers begun to offer electric vehicles or fuel cell vehicles at scale. And so we are now hoping to see some progress with JB Hunt in terms of implementing a target. And then finally, I've just mentioned First Solar, obviously another business that is providing solar modules, a key part of the decarbonisation story, but they themselves use a lot of energy in making those solar modules, and we need to see them now deliver on their plan to source more renewable energy for their manufacturing. So I thought it was helpful just to see both the focus on these top 5 companies. The bottom 10, by the way, represent less than 0.1% of our emissions. So it's really these companies are the ones that matter, and that's where we're targeting our engagement. And then just finally, a couple of final slides from me before we open for questions. I mentioned a few moments ago that we've done a lot of work around policy and standard setting in impact investing and sustainability more generally. We've seen a sort of an avalanche of policy initiatives in the space around the world. And we think it's really important that we ensure that these standards aim as high as they can in terms of the strictness of the application of labels and definitions around impact investing and sustainability. And so even as a relatively small business, we've spent a lot of time working with groups like the Global Impact Investing Network to get them to help them develop guidance on what impact investing in listed equities should mean. So we spent a lot of time with that working group, got a nice quote for them to illustrate how significant our input has been. We've done a lot of work with the UK's Financial Conduct Authority on their SDR regime, which is a labelling regime for funds, which will have an impact label, and again, wanted to make sure that that's set at the right standard. And then also with a group called the British Standards Institute that sets standards around all sorts of things, and they're doing a series on sustainable finance. And again, we want to make sure that that has real, sets again a really high standard around what we mean by sustainability and impact investing. We think that's part of our role, part of our mission really, is to try and ensure that the movement as a whole sets high standards around these topics. And then in a similar vein, really, we are extremely transparent about the way that we operate. We think this is a strength of ours. I've shown you the impact map, the impact calculator today. We've got some new reports called the Net Zero Carbon Report, which is just about the net zero carbon activities that we have. Our stewardship and engagement brochure. There's the impact report. There's a separate stewardship report. We published the minutes of our advisory committee meetings, which we're having one later on today, and that'll be published next week. And we publish a page on every single company that we hold in our portfolio. And we think that all impact managers should do this. We think if you want to claim to be an impact investor, then you should show exactly what you invest in. We think it's a bit outrageous, frankly, that there's still quite a lot of resistance to disclosing your whole holdings as impact managers. And we think that everyone should be publishing everything that they own in their portfolios. So with that, I'll conclude. There's a lot more information in the impact report. I would encourage you to take a look at it. But thank you very much for your attention. And I think we'll now turn over for questions. Thank you very much.
We have received a few questions, and I will get started with those. If there are others, please don't hold back. The first one is quite a long one, but I think it's a good one, and I'm not actually sure who it should be directed to. So Seb, I'll start with you, but Claire, please weigh in if you think that you have anything to add. The question is, given that we have been told, given everything that we've been told about the demand for renewable energy solutions, does it surprise you that the potential for an economic slowdown has resulted in the lackluster recent performance of some of these companies, especially considering the government stimulus? And the second part of this question, which I think is very good, is what should we read into that? Is the market telling us that we are being too optimistic about the transition?
Yeah, thank you. Yes, a good question. Actually, it's I was just trying to find this quote. There was an article in the Financial Times a week or so ago that was written by a couple of US academics. And I'll just quote a little bit of it, actually, because I thought it was very interesting. In it, they said that, quote, green stocks overcame their lower expected returns to produce higher realized returns thanks to shocks or, quote, luck in the form of unforeseen bad climate news. And it goes on to say that, like other shocks, the climate shocks that caused past green outperformance cannot be expected to continue. And I think it's quite an astonishing thing to read, because if it's representative of the market as a whole, then it does reveal, I think, a profound misunderstanding of climate science. I mean, the whole point really is that without rapid reductions in greenhouse gas emissions, not only can we expect more shocks, so the academics are saying we can't expect any more shocks. We would say absolutely we can expect more shocks, and we're kind of seeing it at the moment in Europe, but also we can expect bigger shocks. So, and I think we're having, as I say, I think we're having a foretaste of that in Europe at the moment. So, I guess it is possible that we're being too optimistic about the green transition, but I think it's much more likely that the market as a whole is not yet recognizing how bad the impacts of climate change are going to be. and what that will do in terms of the inevitable policy support that low and zero carbon technologies will receive. So that would be my view, that actually the market just hasn't really understood this yet, and isn't really therefore anticipating the growth in support that we'll see for green technologies.
Lending weight to the title of your impact report about the age of adoption, of course. Next question, Claire, this one's for you. This is the second year of performance lagging the benchmark. What is it going to take to turn this around?
Yeah, I think what we've seen over the last couple of years, particularly in the last 18 months, has been very extreme dispersion between sectors. So basically what we've seen is that there have been big sector swings within the index, and they've been quite extreme and very different. So in 2022, for example, fossil fuel energy doubled its weight in the index because it was so strong. This year, fossil fuel energy is one of the weakest sectors. Similarly, last year, technology was one of the weakest sectors, and this year it's driving huge stock market returns. And when you actually think about what we've seen this year, which is, 10 companies driving the majority of stock market returns, I just don't think that can be rational. It definitely underappreciates the growth opportunity for other companies that are perfectly good businesses that are delivering strong growth, that have good margins, that are growing their earnings, many of which are in our portfolio. And it's just, for some reason, the market has been, quite irrational. And I think that a lot of that can be put down to just the uncertainty with regards to the economy at the moment. So there's just a lot of different views around what's next for inflation, what's next for interest rates, how far do interest rates come down, how fast do they return to normal. And those views can change quite dramatically in quite a short amount of time. And you see the chair of the US Federal Reserve, I think a few months ago, said, this isn't a pause. Those 4 or 5 words cause the stock market to rally. And then next day he'll say something different and it will fall, and it's just extreme. And I think really what I'm getting at is that what we need is better certainty and better stability in the economy, and particularly in inflation and interest rates. The good news is, as I've kind of said earlier, that we are starting to see that. US inflation last month was 3%. They target 2%. Whether it stays there or whether it kind of continues to move around for a while, I don't know, but it's definitely better than where it was, which was double digits. And similarly, the UK, which was one of the worst, one of the countries that suffered the highest inflation, partly compounded by Brexit, that has come in below expectations and is finally back to single digits. Again, whether it stays there, I don't know. But I think we just need to return to something that resembles normality. And I think we are getting there. It's just taking a bit of time.
Excellent. Next question, Seb, are you concerned that by providing the detail about the impact engine and even your approach to impact investing, that you could be giving away some of your IP or undermining your potential point of difference?
Yeah, that's a really good question. Actually, it's something that I think it was Claire raised once in an investment team meeting that we were having. I mean, I think for us, the data itself cannot be the USP. I mean, we want this data really to be available to the market as a whole. We want more and more investors to think this way, not just because that will likely support the kinds of companies that we're investing in grow the market, but we need to see more investors think this way if we want to see the transition to a more sustainable economy. So I don't think the data itself is the USP. I think the way that we think about it and the way we integrate that information into our investment process, and it's taken a lot of time to really build our knowledge of how the impact engine works and how we can use that as an investment tool, that is very precious to us, and is something that we don't want to share too much. I think the worked example that we've got in the impact report this year is there partly because we felt like we needed to share a bit more about how this works in practice. It was something, again, that our advisory committee said that they thought we should do. I think we won't want to go much further than that, at least for the next few years. But the data itself, I think, is something that we want everyone to be using. So that shouldn't be the USP that we have.
And to clarify, USP is unique sales proposition.
Oh, yes, yeah.
Now, on that same note, we've got a question. Please can you clarify the advantages? You spoke about the advantages of using a third party for the measurement of impact, because the question is around, I'm not sure I can understand the impact relative to other funds when we just have absolute numbers.
Yes, so that's a nice question as well. Thank you for that. The problem is we can't record our impact against an index because there isn't impact data for the index. In terms of at least many of the impact calculator metrics that we have. I might just show my screen because we do have in the report this spidergram. So this is some data that actually, again, it's from a third party called Impact Cubed. And it's a kind of an output from our process, so that we're not using their data to manage our process, but it's more about reporting the information once we've generated it. And so we don't always share exactly the same definitions with them. But what they've done here, and we've done this for I think 4 years now, is shown our portfolio relative to, and this is the MSCI World, that light coloured one. So from an impact point of view, a lot of this is more sort of ESG focused, like governance and gender equality and things. And we talk about this in the report where we underperform, we talk about those. But on the kind of key metrics that we're focused on from an impact point of view, so the proportion of the fund that's invested in companies doing environmental good or social good, and then environmental harm and social harm, and anything further away from the center is better. So you can see we're dramatically better than the index. We think we're even better than this, actually. We think we don't share their definition of environmental good and social good, but as you can see, that's one way of comparing with an index, and the numbers are, I think we've reported the numbers, or the numbers are here on the right hand side. So that's one way we do it. It's not exactly the same as the impact calculator. It's looking at a slightly different set of data. The other way of doing it is showing year on year how it changes, and again, that's in the report. One of the challenges we have in terms of carbon is that, so we used to report our carbon footprint relative to the MSCI World, and I think we probably still do somewhere. That's the obvious thing to do, that's our benchmark. But for many years, I mean, it doesn't really tell you anything about our footprint, it tells you what's happening in the index. So for many years, we were much better than the index because oil and gas was such a big part of the index. Then in the early kind of 2020s, late 2019, the teens, tech became such a big part of the index and oil and gas became much less relevant. So the index was moving around a lot because of that. And our footprint wasn't really changing very much. But so you're comparing yourself against something that you have no real relationship with at all. So what we tend to do is do it year on year. And ultimately, at least as far as carbon is concerned, you just want to get to zero. You're trying to get to zero. And that's what you should be measuring us against, not against an index. We don't think that really tells you anything interesting. So there's an absolute target with carbon that we're aiming for, which is zero.
I think that makes sense. And last question, and this is also for you, Seb. 70% of emissions from 5 companies, but all of these companies are involved in carbon reducing activities. Is it possible to better reflect the net impact in your reporting?
Yeah, thank you for that. And that's a common question, actually. In the report, there are a couple of interviews that we've done this year, which I hope people will find useful. One is on, we interviewed companies to get a sense of how they feel about all the engagement they're having to do now. So there's, I think, a really interesting perspective from the companies on that. The other one is a rather technical interview on avoided carbon emissions, which is partly the answer to this question. And his view, which absolutely we share, is that you can't net off the carbon avoided that's associated with the products that you sell against your own carbon emissions as a company. That's not allowed from an accounting point of view, and that it doesn't make sense to try and do that. So we don't do that. What you can do, and what one of the proposals that Stephen has suggested in the interview, is that you do a ratio. So you can report of the carbon avoided, the carbon emissions that are avoided through the products and services that you sell, and then separately you can report the Scope 1 and 2 emissions and report that as a ratio. And we think that's actually a very good idea, and we'll probably start doing that in future years. So you should look forward to seeing that in our reporting in future.
Right. I will watch for that. So that concludes our questions. If you have any others that you didn't ask this afternoon, or if you're watching the recording and have questions, please get in touch with us. We'd love to hear from you. Seb and Claire, thank you very much for presenting, and everybody else, thank you very much for joining. Enjoy your evening.